Hello, this is the video of problem 4.5a, which is kind of a long comprehensive problem on the completion of the accounting cycle. We have here a bunch of different journal entries that we need to book. Then we're given kind of a chart of accounts, the accounts that we need to use. We need to prepare unadjusted trial balance. Then we have information on additional adjusted entries, adjusting entries which we need to book, and finally we need to prepare the adjusted trial balance and income statement, retained earnings statement, and the balance sheet. So this is going to take us quite a while, but as we work on it, we will get through the whole accounting cycle hopefully. So the first thing I did in this problem is that I took the chart of accounts and that is given to us, and I put it in T account for us to save us a little bit of time. So what I'm going to do, I'm not going to just write journal entries, I'm just going to start putting them straight in the T account. It's a long problem, and it just kind of makes me a little bit more efficient that way. So the first entry that we have here is on July 1st, the following assets were received from Steffi Lopez. In exchange for common stock, cash $13,500, accounts receivable $20,800, supplies $3,200, and office equipment $7,500. There were no liabilities received. So this is basically an owner transferring their own assets to the company in consideration for equity. So essentially, it's a debit to cash of $13,500. Debit to receivables of $20,800, supplies of $3,200, office equipment of $7,500, and the sum of these amounts goes to common stock. So let's quickly calculate what it is. So it's $45,000. So that corresponding credit goes to equity, right, for the sum of this amount. But if you wanted to in fact book journal entry for this, and I'm going to do it for this one because it's kind of a little bit more complex. You debit cash. Debit cash for 13.5. AR $20,800. Office equipment $7,500. And credit goes to common stock of $45,000. So that's the corresponding journal entry there. Right, so I'm going to try to stay away from doing journal entries unless it's more of a complex transaction. The next question says, and then on first journal entry that she pays on July 1st, she pays for 2 months rent on lease rental contract, $4,800. So she prepays her rent in this particular case of $4,800 as a debit, and cash credit $4,800. One. Right. Now, anytime you have a prepaid anything situation, prepaid rent, prepaid insurance, that's a signal that there should be an adjusting entry at the end of the period because any sort of prepayment has to expire over time, right? So you can kind of have a mental note here that there is actually going to be an end of July and adjust the entry to expense 1 month of this. In this case, will be $2,400. Paid premiums on property and casualty insurance policies, $4,500. I'm going to assume that this is simply an expense in this particular case because at least initially, we can actually put it, I guess, in the prepaid, and then it doesn't really tell us for what period. We can put it into prepaid insurance, at least initially, And if, I presume it's for 1 month, so we will expense it as an adjusted entry in the end of the period. So let's just do it that way. Received cash from clients is an advance payment for service to be provided and recorded as an unearned fee. So again, they received cash here of $5,500. And credit unearned fees, $5,500. And it says purchase additional office equipment on account from office station to $6,500. Again, it's a credit to cash of $6,500. And debit to office equipment of $6,500. Then it says received cash from clients in account $15,300. They're collecting an account receivable. So this is a credit to accounts receivable and a debit to cash. I'm running out of space in the cash account, so I'll have to probably write in a bigger page for that. Then it says paid cash and newspaper advertisement $400, so it's a credit to cash of $400. I'm just going to assume that this is a period cost. There's no prepayment going on, so this is going to be an advertising expense, or we can put it into miscellaneous, I guess, because there is no advertising expense in the chart of account. So let's put it here. A paid office station for part of the debt incurred on July 5th, 200. Oh, sorry. Just skip a couple of journal entries. To skip the journal on July 5th, there was a journal entry which we skipped. Says purchase additional office equipment on account $6,500, and I said on account, so I put it in cash. That was wrong. Should have been accounts payable. $6,500 here. That was July 5th correction. Right, and then it says that they paid back part of the debt. $5,200 debit and credit cash $5,200. Recorded services provided an account for the period $13,300. Again, it's a debit to accounts receivable $13,300. Credit in this case, particular case, will be revenue $13,300. $30,300. Paid receptionist to 2 weeks salary, $1,750. That's again credit to cash, $1,750. Debit salaries expense, $1,750. Then we have a bunch of other transactions. Recorded cash received from clients, $94.50, and this is again revenue, $94.50. Paid cash supplies $600. So again, it's a credit to cash, $600. Debit supplies, $600. Recorded services provided an account for the period. Again, it's a revenue on account, $66.50 in this case. Rated revenue, $66. That's fees for. Receive cash from client fees for clients for a fees earned for period. Again, 4,000. Gonna need a new key account for cash. We're already here, 4,000. Running out of space, it was 4,000 here. Receive cash from clients account 12,000. Again, debit 12,000 to cash. Credit AR, in this case, accounts receivable, 12,000. Then we take a minute. I think I need a new larger cash key account. So we set one up. We have everything. Yeah, here. So it says, this is my new nice cash account. Another space. So it says, receive cash from clients for fees earned 4,000. We recorded that one. So, and we receive cash from clients in account 12,000. That. Paid reception is 1750, so it's a credit to cash 1750. And we're going to debit salaries expense. Again, 17. All right. Paid telephone bill for July 325. I'm just going to debit miscellaneous 325 and credit cash 325. Same thing with electricity, 675, 675. Record cash from clients fees earned, 5,200. Again, 5,200 here. And fees earned, 5,200 here. Recorded services provided an account for the remainder of July, 3,000. Again, it's a accounts receivable. In this case, this particular case, it will be 3,000 debit and credit 3,000. The last journal entry is paid dividends of 12,500. So that's a debit to retained earnings and credit to cash. So then, now we're kind of ready to actually go to the next step. We've prepared all of the what's called nominal. We can go and at this point prepare unadjusted trial balance. Now in practice, however, it's really not necessary to get the final financial statements done. You know, because we can go ahead and actually book the adjustments right away. In reality, you know, nobody prepares the unadjusted trial balance and goes to adjustments afterwards, you know, because all the adjustment entries are just additional journal entries. So that's what I'm going to do in the interest of time. And so, you know, we have now kind of here a bunch of adjustments that we need to make. Right, so that we're told what those adjustments are. First of all, it tells us that insurance expired June, July is $375. So whatever prepaid insurance there was during that time needs to be expensed. So it says that there is a $375 so that insurance has been expired. So we need to credit prepaid insurance $375, and we need to debit insurance expense for that amount. It also tells us that supplies in hand on July 31st were $1,525. So we go back to our key account for supplies. It tells us that the balance needs to be $1,525. Well, if you look at what we have here, we have 3,200 plus 600. To make it $1,525, we need a credit for the difference. So 3,800 minus 1,525 is going to be $22.75. So that's a credit. We need to debit, and the debit will be to supplies expense. It also tells us that depreciation of office equipment for the year was $750, for the month. For $750. So that's a depreciation expense entry. So we'll go back to page 3 here. There's a debit to depreciation of $750, credit to accumulated depreciation. And it says accrued receptionist salaries was $175. So again, it's a salary expense debit. And credit should go to the accrued salaries payable. We have salaries payable account. Okay. And again, it says rent expired during July is $2,400. We kind of knew that. Remember when we talked about prepaid rent early on? So it's a credit to prepaid rent of $2,400, and the debit goes again to insurance expense. And finally, unearned fees from July 31st were $2,750. So go back to our unearned fees account. Right here, it says the balance needs to be $2,750. Well, what we have here is $5,500. It needs to go to $2,750, which means that some of the fees were actually, in fact, earned during the month. So that's $2,750 of fees actually to make it balanced, right? I'm just going to check my arithmetic. Yes, but I am right. So this is a debit to unearned fees, and the credit should go to fees, to regular fees, $2,750. So that's pretty much it. I mean, so now you have your all of your entries, your original normal journal entries, your adjusted entries. You can go ahead and prepare the adjusted trial balance. And that's, what that entails is you need to balance out all the accounts and just simply list them out. That's what we're going to do next. So in the meantime, while we were working, I basically went ahead and calculated all the different final balances in RT accounts, and so to save us a little bit of time, so we wouldn't have to do it while you guys are watching the video. So the final balance in the cash account, for example, was 32,450, AR 16,450, and so on. So these are final adjusted balances. Like I said, we bypass in the interest of starting the preparation of unadjusted trial balance. It's really not necessary anyway. So now we can prepare the adjusted trial balance. Adjusted TB trial balance. So adjusted trial balances is we're gonna write debits on the left, credits on the right. So cash is 34. Cash is 32,450. AR is 16,450. Supplies is 1525. Prepaid rent 400. Prepaid insurance is 4125. Office equipment 14,000. I'll write accumulated depreciation right below office equipment because it's a counter asset account as a negative. Alright, now we can write credits account payable. We have AP is 1,300, salaries payable 175, unearned fees 2750. And then we have equity accounts, which are a common stock of 45,000. Retained earnings. Currently, it's actually a debit balance because we didn't have any beginning balance, so just as those dividends, 12,500 for now. Then we have fees earned. Now these are already my revenues, so parentheses revenues. I counted 44,350. Then we have some expenses, which go on the debit side, salaries. Expense of 3675. Rent expense of 2,400. Supplies expense 2,275. Depreciation expense 750. Next page. Insurance expense 375. Final miscellaneous expense of 1,400. If you were to add it up, debits and credits, it ends up being 94,325 on both sides. There it is in balance. And finally, all we need to do is the actual close. Remember, all the closing entry is simply you transfer your revenues and expenses into retained earnings. Right? So you need to actually zero out over revenues and expense accounts and the balance, which is net income or loss, gets transferred into retained earnings. So you may notice that what's going to get closed are these accounts here, this account here, here. Okay. We have to go through our key accounts and close them. So we're just going to debit here 44 350. Credit 3675. 2400. 275. That's a zero out. 750. 375. 1400. It's really useful to write out the actual closing journal entry. So there's a debit to fees earned, or parentheses revenues, or 44,350, and credit all the expenses. Salaries expense, 3675, rent expense, 2400, supplies expense, 2275, depreciation expense, 750, insurance expense of 375, and miscellaneous expense of 1400. Nice part about the closing journal entry, of course, is that it essentially produces your income statement right away, right? You can see what the expenses are, what the revenues are, and here goes your income statement, essentially, already prepared right there. Right. All right, so let's compute our net income quickly. And our net income is 33,475. So it's a credit. So it's credit to retain. Okay. Credit to retain earnings 33,475. Now, some your textbook, I think, and some textbooks, instead of going straight to retained earnings, go to what's called income summary account first. So and then they transfer income summary account into retained earnings. So income summary is this kind of like a pass-through account that just captures the balance of net income and then gets closed itself into retained earnings. There's really no need to do that because you can just know that this is net income. So this is your net income here. Okay. So don't forget that this goes. Don't forget to actually enter credit retained earnings for net income, right? This is the final step of adding this 33,470. Apologize for the camera. 33,475, and that gives us our final retained earnings balance. And that retained earnings balance is 2975. Right, so that's what goes to that's what goes onto the balance sheet after everything gets closed. So we can take our adjusted trial balance and not simply rewrite it as a balance sheet, which is what I'm going to do next. So everything pretty much stays the same, except our revenues expenses accounts go away and balance goes to retained earnings. So cash 32,450, accounts receivable 16,450, supplies 1,525, prepaid rent 2,400, prepaid insurance 41,125. This is actually here. These are all the what are called current assets. And typically, you would subtotal them. So leave a little bit of space later to come back to them. So the only non-current assets you got is office equipment. Cumulative depreciation is the same. That should give you total assets. We'll compute in the end. You have my assets. Then on the other side I will have liabilities. And owner's equity, I'll just say OE here. OE is owner's equity. Accounts payable 1,300. Salary payable 75. Fees 2750. Common stock 45,000. And finally, retained earnings of 2975. And that will give us total liabilities and owner's equity. So let us quickly compute what that number is. I get 70,200 here. Compute total assets quickly. And voila, our balance sheet balances. It's also 70,200. It's good to give a subtotal for current assets because it's a separate category in the balance sheet. So we'll just be neat and do that. And total current assets is 56,950. But it's just a subtotal. Alright, so this is my balance sheet right here. My balance sheet. My income statement I pretty much already have. So my closing entry. My income statement. All I need to do essentially just, I won't even rewrite it. You can simply say, this is my revenues, this is my total expenses, just get a subtotal, this is my net income. So this is my income statement right here. So in the interest of time, I'm going to skip that. The last step, of course, is simply a computation of the retained earnings, just preparation of retained earnings statement. So that we have straight from the retained earnings T account, which is right here. The beginning retained earnings was 0, net income was 33,475, and dividends were 12,500. So you can simply type that out. Statement for retained earnings. Beginning retained earnings 0. Net income was 33,475. Dividends were 12,500. So that gives us ending retained earnings of 29.75. Now note that if it's if you have net income, so then it's in fact a credit or addition to retained earnings. If you had a loss, it would have been a debit or subtraction from the retained earnings. Remember that, bear that in mind. So that's pretty much the problem. And if you understand, if you can reproduce what we did here on your own, that means you pretty much understand the whole accounting cycle. So I very much strongly encourage you to work on this problem and make sure that you understand the whole cycle. Thank you very much.